Hi. My name is Income Rule. I look out for my buddy MHE here by limiting the monthly housing expense by a percentage of household income.
Hello. I'm monthly housing expense, you can call me MHE for short. There's a few components that come together to make me.
I'm part of MHE. I'm mortgage payment. You can include the mortgage insurance when you consider me.
I'm your housing tax, a big part of MHE.
Don't forget about me. I'm homeowner insurance premium.
We won't be forgetting any of you three, don't worry. Folks like to know what they are paying for. Let's go through an example of what MHE might come out to. Amy's income is $4,000 a month. Her MHE percent limit is 28%, coming out to a limit of $1,120. This means her taxes and insurance can only amount to $200 and her maximum mortgage payment can be up to $920. Subtract taxes and insurance from the MHE cap to calculate the maximum allowable mortgage payment.
I am the debt rule. I decide the total allowable housing expenses including existing debts and capped by a specific percentage of their income. I do this with a composition of MHE, who we know is made up of mortgage payment, housing taxes, and homeowner insurance, combined with existing debt payments, like car loans and credit cards. Let's go through an example and determine loan capacity from max mortgage payment to infer sale price considering down payment requirements. Tony earns $4,000 a month. His THE limit is maxed at 36%. This equates to $1,440. Let's deduct taxes, insurance, and existing debts from the cap of $1,440 to find the max mortgage payment. Let's deduct taxes, insurance, and existing debts from the cap of $1,440 to find the max mortgage payment. Deducting his existing debt payments of $240 and his taxes and insurance of $200, we're left with a $1,000 allowance. The interest is 7%. At 7% interest for 30 years, $1,000 monthly supports a loan of $150,308. If Tony can make a 5% down payment, the maximum sale price he can purchase is $158,218.
I am the required cash rule. I make sure borrowers like Tony have enough cash for the down payment and settlement costs. For example, if Tony has a limit of $12,000 in cash to cover the down payment and settlement costs, he is limited to a loan of $120,000. Because this is less than what income rule allowed, and what debt rule allowed, we will go with my answer since it's the lowest for risk safety. Tony has a few options to qualify for a higher loan amount. He can ask the seller to pay the settlement costs or use additional funding like help from a family member. Or we can lower the down payment requirement depending on which loan he qualifies for.
Those are great solutions for helping Tony qualify. If he was restrained by my answer, he could provide another income source, or we could try to lower his monthly housing expense by finding a lower housing insurance premium.
If he's restricted by my answer, he needs to repay his debt. This is the only way.
This story takes place in the financial forest. This is the chronicles of Adjustable Archie. Adjustable Archie, a lovable, shifting robot whose antenna adjusts based on changes in the index rate, signifying adjustable rate mortgage, ARM, mechanics. We can't forget Fur Fairy, a mystical creature with wings representing fully indexed rate, FIR. She shifts between glowing brightly, higher rate, and dimly, lower rate, signifying the fur's influence on April changes. Helly the Wise, a wise owl with a compass and financial charts, embodying the life lessons of home equity line of credit, Helic, complexities, APR misunderstandings, a cloud-like creature that obscures clarity, casting a shadow of confusion over borrowers. Memory Optimizer, a wizard with a luminous wand that creates floating thought bubbles and reminds borrowers of key factors to consider. Time Horizon Cost, an advanced calculator character with customizable settings, embodying a tool that considers personalized factors.
I just don't understand, Fur Fairy. Borrowers see my ARM APR as stable, but after the initial period, my antenna adjusts to new high rates. Why don't they see that coming?
It's because APR misunderstandings is out there spreading confusion. Borrowers think APR reflects all future risks, but it doesn't account for possible rate spikes after your initial period.
That's true. When the index changes, so do I. See. If the index goes up, I follow, and APR increases too. Borrowers forget this happens.
Adjustable Archie, Fur Fairy, you don't need to panic. Borrowers face similar confusion with me, the home equity line of credit. My APR reflects only starting rates, never future fluctuations or upfront costs.
That's a major problem, Hallie. If borrowers don't see the importance of calculating margins and points, they won't properly compare their options.
Why worry, dear borrower? APR is all you need, don't trouble yourself with pesky future rates or upfront fees. Trust the starting point.
Stop APR misunderstandings. Borrowers need their memories optimized to recall critical details. ARM APR assumes stable rates, but marginal shifts after the initial period can be risky.
And Hallie's APR only scratches the surface too. It reflects starting rates, but borrowers need a full picture of future costs and upfront expenses. Let's show them why thinking beyond APR is vital.
Whoa, look how my APR spikes after the stable period when FIR is high. Borrowers, remember, my APR is correct, but it doesn't tell you the whole story. Always calculate future risks.
And with me, examine the margin. It's often buried in the fine print, yet it's crucial. Don't rely only on APR, my upfront costs need evaluating too.
I see now. APR alone won't reveal the real costs of ARMs or HELOCs. By understanding FIR and margins, and using tools like time horizon cost, I can make an informed decision.
Another borrower saved by truth and transparency. Remember, we are here to illuminate hidden details.
Let's go down memory lane to Mortgageville with our 8 fantastic characters. For me, the 1003 form, a meticulous, detail-oriented character who always carries a clipboard and loves checklists. Fee the application fee, a money-savvy character who always carries a cash register and charges for everything. Val the appraiser, a wise character who assesses the value of any object. Ami the AMC, a referee-like character ensuring that every appraisal game is played fairly and by the book. Appy the mouse, appraisal fee, a speedy little character who collects coins each time while the appraiser makes a valuation. April the APR, a savvy, business-like character with a calculator watch demonstrating cost calculations. Arnie the arm, a character with an elastic arm, symbolizing the changing rates of a mortgage.
Welcome to Memory Lane. Before we head to Mortgageville, let's ensure we have all the required details. Please complete me, the 1003 form.
Oh, and don't forget about my part. It's a small price for a big dream, but you got to pay the application fee to commence this journey.
While we're at it, let's take a look at this property through these value goggles. I'll give it a thorough appraisal.
Hold up, everyone. I'm here to make sure Val's appraisal is fair and square. No shady business on my watch.
And I'll be taking the appraisal fee. All this running around Val makes me rich in coins.
Now, if everything checks out on Formy's list and Val's appraisal, you'll get my approval hoot. But remember, it might be conditional.
Let's talk numbers. As APR, I'm all about the annual cost of these loans, complete with interest and fees. Keep an eye on me.
And don't overlook me, I'm ARM. I might start out gentle, but I can stretch those interest rates over time. So prepare for some flexibility in your payments.
As we approach Mortgageville, remember that we started with the 1003 form to get your journey going.
Without my little charge, you wouldn't have the pleasure of walking down this path.
The property's value I assessed will secure your investment is sound.
And thanks to me, you can trust that Val's eyes were unbiased.
Remember, I'm the little fee that follows Val's hard work.
Qualification is the key, and with my seal of approval, you've got the wisdom you need.
Cost isn't just the now, it's the year-round picture that APR displays.
And I'm here to shake things up, making sure you remember, loan rates can change, so stay alert.